welcome to the Deep Dive. Today, we're trying to cut through some of the noise around what a company's really worth. We're moving beyond just the day-to-day stock price chatter.
Right.
We're revisiting some foundational ideas using Aswath Damodaran's little book of valuation as our guide, really just to reinforce those core concepts.
Exactly. And what's interesting is, whether you're looking at a tiny startup or a massive corporation, the things that actually drive value, they're pretty consistent. So our mission today, if you like, is just to circle back to those essential ingredients, those key approaches to valuation, make sure we all have a solid handle on them.
Okay, sounds good. So these common ingredients, what are the absolute must-haves when we're talking value?
Well, fundamentally, it really boils down to three things that are all interconnected. You've got the cash flows a company is expected to generate,
Okay.
how much those cash flows are likely to grow over time,
Growth, right.
and critically, the risk involved, the uncertainty around actually getting those cash flows and that growth.
Cash, growth, risk. Got it.
Yeah. And I mean, the emphasis we put on each one, that's what changes. It varies depending on the company, doesn't it?
How so? Like, give me an example.
Well, think about a young tech company, right? It might not be generating much actual cash now.
Right, probably burning through it.
Exactly. But its valuation is heavily tied to its massive growth potential, maybe even years down the line. The risk is high, but so is the potential growth payoff.
Makes sense. You also mentioned a choice between valuing the whole company versus just the equity part. How does that fit with these ingredients?
Yeah, that's a really key distinction. So if you value the entire business, the enterprise value, you're looking at cash flows before any debt payments are made.
Okay.
Your growth estimates are for the whole operation, and the risk reflects the overall business risk.
Right.
But if you're just valuing the equity, what belongs to the shareholders, then you focus specifically on the cash flows left over for them after debt holders are paid.
After debt, okay.
You look at the growth in those specific equity cash flows and the risk faced directly by the equity investors, which can be different from the overall business risk.
And I guess you need to adjust for things like debt levels differently then.
Precisely. Things like cash on hand, the amount of debt, cross-holdings in other companies, how you account for them, depends on whether you're aiming for firm value or equity value. It's also worth noting, for certain types of companies like banks or financial services, it's often easier or maybe more practical to just value the equity directly. Defining their debt can be tricky, and figuring out traditional free cash flows, well, complicated.
Interesting point. Okay, so the core ingredients are cash, growth, risk, and we apply them either to the firm or the equity. Now, you said the models are consistent, but the emphasis shifts. Can you unpack that a bit more?
Sure. So the basic tools we use, whether it's, say, intrinsic valuation, like discounted cash flow, trying to find that true underlying value, or relative valuation, where you compare a company to its peers using market multiples, like PE ratios and stuff.
Exactly. Those frameworks, they're broadly applicable. But what you focus on within those frameworks changes, sometimes quite dramatically. It depends heavily on the company's life cycle stage and its industry.
So like for a young company versus an old one.
Precisely. For a young, high-growth company, what really matters? Potential revenue growth is huge. Also, their path to profitability, that target margin they hope to achieve as they scale.
Right.
And honestly, sometimes it's just the basic probability of survival. Will this company even make it? That's a key driver.
Survival probability. Yeah, that feels very real for early stage stuff.
It really is. Now, contrast that with a mature, established company, maybe a steady dividend payer.
Okay.
There, the focus might shift. You might look for what Damodaran calls operating slack areas where they could be more efficient, cut costs.
Opportunities for improvement.
Or financial slack, maybe they have too much cash sitting around, or they could borrow more cheaply to fund projects. Sometimes, even the possibility of new management coming in to shake things up becomes a value driver.
Yeah.
Interesting. And what about those financial service firms again?
Right. For them, the emphasis shifts again. Things like the specific risk tied to their equity are crucial. Also, the quality of their growth matters a lot, not just growth, but growth achieved with a good return on equity. And, of course, regulatory capital. How much of a buffer do they have? That's a big factor in their valuation.
So, same tools, different focus points depending on the context. Very clear. But how do we know if doing all this valuation work actually pays off? Does it lead to better investment decisions?
That's the million-dollar question, isn't it? Damodaran points to three main things here. First, well, the quality of your valuation. Did you use good information? Is your reasoning sound?
Well, Makes sense. Garbage in, garbage out.
Pretty much. Second, you need the market to eventually agree with you or at least correct its own mistakes. Market feedback is key, but, markets can stay irrational longer than you can stay solvent, as the saying goes. It might take time.
Patience is needed then.
Definitely. And third, well, there's luck.
Luck. Can't escape it.
Can't escape it. But you can manage its impact maybe by diversifying, not putting all your eggs in one valuation basket. So it's skill, patience, and acknowledging a bit of luck.
Okay, so wrapping up. The book gives some rules for the road. Any key ones that really hammer home these core ideas we've discussed?
Yeah, a few really stand out. One is always go back to first principles. Cash flow, growth, risk. Even if you ditch a specific model, don't ditch those fundamentals.
Stick to the basics.
Exactly. Another big one, be aware of what the market mood is, the sentiment, but don't let it be your only guide. You need your own analysis.
Don't just follow the herd.
Right. Also, remember that growth isn't automatically good. If it costs too much to achieve that growth, if the returns aren't there, it can actually destroy value.
Good point. Growth needs to be profitable growth.
Precisely. And related to that, recognize that high growth doesn't last forever. Every company matures eventually. You have to factor that in. And importantly, always account for what's called truncation risk, the chance, especially for younger or troubled companies, that the story just ends. They fail.
The risk of failure. Okay.
Yeah. Look forward, not just backward at historical data, and finally just embrace the uncertainty. Valuation is estimates and probabilities, not perfect prediction. Deal with the uncertainty. Don't pretend it isn't there.
That's a lot of wisdom packed in there. So the main takeaway for everyone listening.
I think the central idea really is that even though valuation can seem super complex with all the models and jargon,
Yeah, it can feel overwhelming.
the fundamental principles are actually quite consistent. No matter the company, you're always coming back to those core pillars: cash flow, growth, and risk. The key skill is understanding how the emphasis shifts, which specific levers within those categories matter most, depending on the company's situation, its age, its industry, its financial health.
So understand the core, but know where to focus your attention.
That's it exactly. Get those principles down and you'll be much better equipped to navigate any valuation you encounter.
That really clarifies things. It's about the fundamentals and the context.
Couldn't have said it better.
All right, great stuff. And to leave you with something to think about, considering these core ideas, cash flow, growth, risks, and how the focus shifts, what assumptions do you think are the most important to challenge or scrutinize the next time you look at a company's valuation? Thanks for joining us for this deep dive.